Hello and welcome back. This is David from the Personal Finance Squad. Okay, now we're going to get into Chapter 12, which is Other Retirement Plans. So in the last chapter, we read through 401k. That's the main one. That's what most people know about. Now there are others such as 457 plans and 403 plans, and we'll touch those in another section. But the main one, again, is 401k that most people identify with. It's the most popular. However, in some companies, they may have 401ks, or they may also have 401ks that also come with other elements such as profit sharing. So we can read right here and we can say right off the bat, there are 401k sharing plans where the employer has a 401k with a profit sharing feature. So it's added to the 401k. Now, profit sharing by definition, as you can see here, says is where you receive shares of the company's profits, and what is distributed is on the discretion of the employer. So profit sharing, you must know, is on discretion of the employer. They do not have to give you a profit sharing. They could have a profit sharing plan and stop it if they wanted to, and they could also start one at any given time. So if your employer actually has one, what they do is they take the amount that goes into an account, and the percentage of those profits is based on their earnings. Now also, your company may offer a profit sharing separate from the 401k. So up here we said they may have an element added to the 401k. Down here we're saying it might just be a separate piece. In some cases they may not have a 401k at all. So let's look down here, which is a pretty common way to determine a profit sharing for a company, and that's a comp to comp method. This is where the employer sums all of its employees' compensation, and then they say the company determines what percentage of the profit sharing each employee is entitled to, and that's what we just said above. And now they have to do it based on a formula. And this is how this type of plan would work. So we have an example here, and we have 3 employees that work for a small company, and you can see that each one has a different salary. You have 50 grand, 75 grand, and 100 grand. Now, the business says, you know what, I'm going to give 12% of my profits back to the employee base. So we went further and said, here's 12%, and we said that the company earned profit of $200,000. So based upon that, we have to put in calculations, and this is how they go. You can see the first calculation here takes the totals. So you have to go, I have the 50,000, the 75,000, and the 100,000, and it's $225,000. So that's the base number where they come up with the formula. Okay? So we'll look at that in a second. Now we can see employee number 1 is the $50,000 earner. So now we take the $200,000 here. That's the earnings multiplied by what they're going to give to the employees, which is 12%, and it comes out to be $24,000. Now you have to do the second half of the figure where you take that amount and multiply it by the employee's salary divided by this cumulative total up here of all the employees' salaries. So if you divide that number, you get 0.222. So when you multiply them together, that would mean in this case, employee number 1 would get $5,333. And now you can see for employee 2 and 3, it's going to be higher because like anything else, when you make more, you're going to earn more when it comes down to bonuses of this type and in companies generally speaking. So if you run the numbers again at the $75,000 salary and the $100,000 salary, you can see that this employee here, number 2, would get $8 grand, and this employee here would get $10,656. Okay, one last side piece here. There are limits, and that is set by the government of how much money you could actually get. And as of 2016, when this video was made, it tells you at 25% of total eligible payroll, limited to $265,000 per participant. So that means the highest amount of profit sharing amount can be given to an employee is $66,250 based on the 265 and the 25 threshold. So $66,250 is pretty nice, so I think most of us would take that, but companies do have limits on that for certain reasons, and so that's what you'll be deemed to. So that's going to cover it for profit sharing as a general look through, and you can see right here that comp to comp method is the most common one, and that's what we've stuck to here. So note, if you do have profit sharing, that's great. Most companies don't have it these days. It used to be a thing of the past, especially when the middle class was strong and there were a lot more unionized places and a lot more side businesses that were stable and independent. But on the whole here, even the big companies of today, profit sharing is not a normal thing. It's gone more by way of the 401k. And that's just a little last piece of information for you, and that's what will do it for this particular video. And in the next section, in 12.1, we will get into ESOPs, which are employee stock ownership programs. Okay, so thanks for joining, and we will see you in the next video.